Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Now that you know the basics, let's break down how to invest wisely and spot real opportunities in the market. Master Limited Partnerships, MLPs. MLPs are tax-advantaged investments focused on energy infrastructure. Key perks: they pass most income to investors as dividends, avoiding corporate taxes. Yields often exceed 5 to 7% thanks to stable pipeline cash flows. But tax filings get complex since MLPs issue K-1 forms, and debt-heavy structures can stumble if interest rates spike. Alternative energy investments. Renewables like solar and wind don't replace oil and gas yet, but they're changing the game. Consider diversified energy giants. BP and Shell now invest heavily in renewables, balancing traditional and new energy. Pure-play green firms. NextEra Energy thrives on wind farms, though growth depends on subsidies. Fossil fuels aren't disappearing soon, but ignoring the energy transition could leave portfolios stranded. Every investment type carries trade-offs. Knowing them helps you build a strategy that fits your risk tolerance and timeline. Risks associated with oil and natural gas investments. No investment comes without risks, and oil and gas are no exception. Prices swing wildly, regulations tighten, and unexpected breakdowns can drain profits fast. If you're jumping into this sector, knowing the risks helps you manage them and maybe even turn them into advantages. Market volatility risks. Oil and gas prices are famously unpredictable. One day, a barrel of crude might climb on news of a supply shortage. The next, prices could crash because a new tech cuts demand. Here's what fuels the roller coaster. Global events. A war, OPEC decision, or economic slowdown can instantly reshape markets. Inventories. Oversupply tanks prices. Low reserves push them higher. Speculation. Traders betting on futures add fuel to price swings. For investors, this means portfolios can gain or lose value overnight. Diversifying across energy stocks, commodities, and other sectors helps cushion the blows. Regulatory and environmental risks. Governments and activists are pushing harder than ever for cleaner energy. That pressure translates to policies that can squeeze oil and gas profits. Carbon taxes. Adding fees for emissions cuts into margins. Drilling bans. New restrictions on federal lands limit production. Renewable mandates. Laws favoring wind and solar shift investment away from fossil fuels. Even without new laws, public protests or lawsuits can delay projects for years. Companies adapting early, like those investing in carbon capture, may fare better long-term. Operational risks. Getting oil and gas from the ground to your tank is messy work. A lot can go wrong, and when it does, costs spiral. Extraction challenges. Dry wells or complex geology can make drilling far more expensive than planned. Pipeline disruptions. Leaks, protests, or maintenance shutdowns halt shipments. Accidents. Explosions, spills, or worker injuries lead to lawsuits, fines, and PR nightmares. These risks hit upstream and midstream companies hardest. Checking a firm's safety record and maintenance history gives clues about its risk level. Mitigation isn't just about avoiding losses, it's about spotting companies that handle risks better than rivals. That's where long-term winners often emerge. Strategies for successful investing. Oil and gas investing isn't just about picking winners. It's about playing the long game with smart tactics. The sector's volatility and complexity demand a strategic approach. Here's how to tilt the odds in your favor. Diversification across subsectors. Putting all your money into a single corner of the oil and gas industry is like relying on one pipeline. It's risky. Spread your bets across these three key areas: upstream, exploration, and production. Companies like EOG Resources thrive when oil prices rise, but they're also the first to suffer in downturns. Midstream, pipelines, and storage. Firms like Enterprise Products Partners generate steady income from transportation fees, softening the blow of price swings. Downstream, refining, and retail. Players like Marathon Petroleum benefit from cheaper crude costs, as refined product margins often stay stable. Balancing exposure across these segments reduces risk. For example, if low oil prices hurt drillers, refiners might offset those losses. Timing the market versus long-term holding. Trying to outguess oil prices is a tough game. Here's why. Short-term trading works for those glued to news and charts. Geopolitical events or inventory reports can trigger sudden moves. But mistiming a trade can wipe out gains fast. Long-term holding focuses on durable trends like rising global energy demand or infrastructure growth. Dividend-paying midstream stocks or integrated giants, think Shell, suit this approach. Most investors do better with a core long-term position, say a pipeline ETF, and a smaller speculative slice for trading opportunities. Monitoring key indicators. Watching these signals helps you stay ahead. Rig counts, Baker Hughes reports. Rising rigs mean more supply ahead. Falling counts hint at tighter supplies. Inventory levels, EIA weekly data. High stockpiles push prices down. Low reserves lift them. Geopolitical news. OPEC meetings, sanctions, or conflicts can upend supply chains overnight. Refining margins. Crack spreads, the difference between crude and refined product prices, reveal downstream profitability. Set alerts for major reports, but don't overreact to noise. Trends matter more than daily blips. The future of oil and natural gas investments. The energy world is changing fast. Renewable power is growing, technology keeps improving, and investors care more than ever about sustainability. But oil and gas aren't going away, they're evolving. Understanding these shifts helps you spot smart opportunities. Impact of renewable energy transition. Wind and solar are getting cheaper, and governments worldwide are pushing for cleaner energy. This shift will slow oil and gas demand, but not eliminate it. A few key points. Transportation. Electric vehicles could cut gasoline use, but planes, ships, and heavy trucks still rely on fossil fuels. Industrial needs. Factories making plastics, chemicals, and steel need oil and gas as feedstocks, not just fuel. Global gaps. Developing nations may stick with fossil fuels longer due to cost and infrastructure limits. The smart money is on companies adapting to this mix, like those investing in carbon capture or hydrogen made from natural gas. Technological advancements. Innovation keeps oil and gas competitive. Two game changers. Fracking. It unlocked vast shale reserves, turning the U.S. into an energy exporter. New techniques could further boost output. Deep water drilling. Robots and sensors now reach oil miles underwater, opening untapped fields off Brazil and West Africa. AI and automation. Predicting equipment failures saves costs, while drones monitor pipelines for leaks. These advances lower production costs, helping firms profit even when prices dip. Sustainable investing trends. ESG, environmental, social, governance, isn't just a buzzword. It's reshaping portfolios. Here's how. Investor pressure. Funds managing trillions now demand cleaner operations. Firms ignoring emissions face divestment. New rules. Governments require climate risk disclosures, making dirty assets harder to sell. Green premiums. Companies with strong ESG scores often get cheaper loans and higher share prices. But sustainable doesn't always mean no fossil fuels. Some funds now back gas projects as a bridge from coal to renewables. The future isn't black and white. Oil and gas will keep generating cash, but winners will balance old-school resources with new world demands. Oil and gas investments offer real opportunities, steady demand, potential dividends, and exposure to a critical sector. But the market moves fast. Prices swing, regulations shift, and not every company adapts well. The key is balancing risk with strategy. Diversify across upstream, midstream, and downstream players. Keep an eye on global trends, but don't chase every headline. And remember, renewables are changing the game, not ending it. If you're considering this space, do your homework. Study company financials, track inventory reports, and understand your own risk tolerance. The right approach could fuel your portfolio for years. Ready to take the next step? Start small, stay informed, and adjust as you learn. The energy market always has another move. Will you be ready for it? Please comment, like, share, and subscribe for more automotive information like this. Thank you for watching. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.